Did you know that Seoul's office market has one of the lowest vacancy rates in the world, hovering around just 2%? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The Seoul office market is currently one of the most resilient sectors in commercial real estate globally, with landlords experiencing what can be described as a golden era. According to Robert Wilkinson, the Deputy Managing Director at CBRE Korea, vacancy rates in Seoul's Grade A office market remain at record lows, leading to a significant rise in prime rents. This scarcity is primarily due to the limited new supply of office spaces in central Seoul, driven by land availability constraints and stringent zoning regulations. The demand, fueled by domestic conglomerates and financial institutions, remains robust, especially for centrally located high-spec buildings. In this landlord-favorable environment, effective rents have surged, with some buildings seeing increases of up to 50% over the last 3 years. Tenants needing larger spaces find themselves with limited options, often forced to renew leases at higher rates or relocate. The top-performing assets, those that are LEED certified and transit connected, are seeing the highest competition. However, there are emerging signs that this dynamic could shift. Economic uncertainties, both domestically and globally, may soon impact leasing momentum. Korea's gross domestic product growth is moderating, and export-focused businesses are facing challenges from geopolitical tensions and softening global demand. Moreover, while the tech sector remains a significant demand driver, it's not immune to cost rationalization. Some Korean startups and tech companies are reassessing their office needs amid tighter funding and evolving work models. The hybrid work trend, although slower to catch on in Korea compared to the United States or the United Kingdom, is gaining traction, especially among younger professionals and multinational firms. This shift towards reoptimization, or doing more with less, is becoming more prevalent. Looking ahead, the supply pipeline poses a potential disruption. Several large-scale projects are expected to be delivered between 2026 and 2031. Many located in the central business district and designed with advanced ESG, digital, and wellness features. If these projects come online faster than demand grows, the current supply-constrained market could change dramatically. Tenant expectations are also evolving, with a growing emphasis on flexibility, smart building infrastructure, and mixed-use ecosystems. Older buildings may struggle to compete without renovation plans, leading to a bifurcated market where only top-tier assets maintain pricing power. For investors, Seoul remains an attractive proposition, though competition is fierce. Despite low cap rates, institutional capital from North America, Singapore, and Hong Kong continues to view Seoul as a stable market, albeit with a wait-and-see approach regarding possible pricing corrections from upcoming supply. There's also a notable trend of investor interest in value-add opportunities, where older office buildings are repositioned to meet ESG and wellness standards. These may offer higher returns in a market with little room for yield compression. In summary, while Seoul's office market fundamentals appear sound in the short term, with limited available space and steady tenant demand, the future could see a rebalance in power dynamics. Economic softening, changing workplace trends, and a potential influx of supply might alter the landscape over the next 12 to 24 months. Landlords should consider investing in upgrades and tenant experiences to future-proof assets, while tenants may need to explore early renewal strategies and creative space planning to manage costs effectively. Elliott Investment Management has recently taken a position in Rexford Industrial Realty, a self-administered and self-managed full-service real estate investment trust focused on the Southern California infill markets. This move comes as the industrial real estate investment trust sector benefits from strong secular tailwinds, notably the rise of e-commerce, which increases warehousing needs. Southern California, with its entitlement challenges, land scarcity, proximity to ports, and dense urban population, has seen fast rent growth, making it an attractive market. Rexford Industrial Realty has historically commanded a top market valuation, trading at a premium to net asset value and an adjusted funds from operations basis compared to its peers. However, it has faced challenges typical of real estate investment trusts, including governance issues and management interests that may not always align with shareholder value. Despite being based in California, Rexford is domiciled in Maryland, a state known for management-friendly regulations, which some view as a strategic move for entrenchment. Since its initial public offering in 2013, Rexford has significantly increased its share count and debt, growing its assets remarkably. However, as its premium to net asset value began to decline, sales, general, and administrative expenses increased, and corporate governance issues became apparent. Consequently, Rexford's stock price fell significantly from its previous highs. Elliott Investment Management, known for its activism, sees an opportunity to drive change at Rexford. The firm is expected to advocate for better corporate governance and capital allocation to restore Rexford's strategic focus on creating shareholder value. Although activism can be challenging in Maryland, Elliott's experience suggests that they can effectively navigate these hurdles. The presence of Elliott could also attract attention from strategic investors and private equity, given Rexford's premium assets and current discounted valuation. This makes it a potential acquisition target. Elliott's history of catalyzing strategic outcomes in similar scenarios suggests that they might weigh the benefits of a potential acquisition against long-term standalone plans to deliver the best value for shareholders. Let's pivot to a unique perspective on creating impactful content in the commercial real estate sector. Alan Buchanan, a principal with Lee & Associates Commercial Real Estate Services, recently shared insights on the importance of consistency, authenticity, and relevance in content creation. Buchanan's journey began back in 2009 when he launched a blog called Location Advice. At that time, it was uncommon for commercial real estate brokers to publicly share insights, but Buchanan saw an opportunity to connect with owners, occupants, and other brokers beyond the traditional methods of postcards and cold calls. His experiment led to the creation of Tuesday Traffic Tips in 2013, a series of short YouTube videos that offered practical advice on brokerage. Buchanan posted these videos weekly, without a studio or script, embodying a consistent commitment to content creation. He was among the first in the commercial real estate industry to leverage content in this way, which opened new doors for him, including a column in the Southern California News Group, facilitated by his presence on platforms like Twitter, now known as X. Buchanan emphasizes that the goal of his content was never about gaining followers, likes, or clicks. Instead, he believed that visibility builds credibility, which in turn fosters trust. By consistently showing up online with valuable ideas, he could create value for his audience before ever meeting them in person. Over the years, this approach has led to new clients, colleagues, and a broader network, demonstrating the power of building trust at scale. The key takeaways from Buchanan's experience are the importance of consistency, authenticity, and relevance. He stresses that memorable content is achieved by showing up regularly, being true to oneself, and speaking directly to the audience's needs. This approach is not just about going viral, but about creating a brand that people trust over time. In the realm of commercial real estate, whether you're in Kitchener-Waterloo, London, Cambridge, Ontario, or elsewhere, focusing on these three qualities can help you stand out. By consistently delivering authentic and relevant content, you can build a brand that resonates with your audience, creating lasting relationships and opportunities. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Haymoon. See you on the next one.